Will we cruise along then, just like that next week? Let's bring on board our experts. Joining in, we've got Ajay Bodke, who is Head Investment Strategist and Advisory at Prabhudas Lilladher. Jyotivardhan Jaipuria of Bank of America Merrill Lynch joins in as well. Gentlemen, many thanks for taking time out for us. Ajay, I'd like to begin by asking you, I want a quick comment first on what it is that S&P is put out today. You know, are you at all rattled by the fact that the ratings agency remains pretty bearish on India?
I think, in my view, what S&P has done is they've acknowledged the fact that the government's fiscal consolidation efforts in containing the fiscal deficit
Is pretty bearish on India?
I think, in my view, what S&P has done is they've acknowledged the fact that the government's fiscal consolidation efforts in containing the fiscal deficit to 5.2% in last financial year and its resolve to contain it to 4.8% is what will be closely watched. They also said that, the current account deficit continues to remain high at around 4% of GDP for FY14. It will still necessitate, in our view, a total gap of around $90 to $95 billion that needs to be bridged through capital flows, that is FI flows, FDI flows and ECPs, which is a pretty large number. It's also important to note that the government needs to stick to its fiscal deficit target because that will help RBI in terms of lowering interest rates, and also productive sectors of the economy will gain, because what's happened is that although the repo rates have come down by 100 basis points over the last 1 year, the persistent concern that corporate India has been voicing is that there has not been much of transmission of those fallen rates to the corporate sector. And I think that sort of will aid if the government sticks to its target of sticking to 4.8% of fiscal deficit. The other point is that with an expectation of near normal monsoons, one can expect a 0.3 to 0.5% addition to the agricultural GDP. Last year we've had a very bad month of June, although the monsoons did pick up subsequently.
Right, Ajay, so I distinctly remember last time when S&P issued a profit warning that really spooked the markets. Do you think we can safely ignore this time's sort of profit warning or status quo?
Yeah. I think the key difference today is simply liquidity. I think, as you mentioned in the beginning of the show, around $17 billion of money has flown into India, and I think Japan clearly has been the monetary shock and awe announced by Japan a few months back has been the game changer. So now, in addition to the fact that America and UK for printing money, you have Japan printing nearly 16% of its GDP is the kind of total liquidity pumping that they're going to do. So I think globally the liquidity situation continues to be so, there's an avalanche of liquidity sloshing around, finding its way into those markets where there is growth. And India, even at 6% expected growth, 6.5% if you were to believe Rangarajan, and 5.7 still would be among the top 2 or 3 high growth markets. And hence I think from liquidity front you can't fight liquidity. So the markets will continue to move up on the back of this liquidity. However, let me also warn that from a valuations perspective, we are today trading at something like 14.7 times FY14 earnings and 12.9 times FY15 earnings. If I just look at the Nifty's last 10 years average of 1 year forward earnings, it is 13.5 times. We are already at 6% premium to that.
Jyoti, I want to bring you in then. How would you call the market right now? Do you think the best of the rally is perhaps behind us? Or do you think it's something different that we're going to see this time round and perhaps could just be the start of it all?
See, what we've had is a very sharp move in the last 1 month. So, there were obviously the positive factors with oil coming down, gold coming down. And so, everybody's now playing this theme that rates in India will come down. Current data will continue to be poor, but, let's think of the future, which will get better. My view is that there will be a cap on the market because ultimately earnings and the GDP growth are not going to be very exciting over the next 6-9 months. Secondly, we have elections towards the end of the year in major states and early part of next year for the whole Lok Sabha. So to that extent, there will be those two factors which will put a cap on the market. What it's done is it's brought investors back. At least the interest is much more in India than we've seen over past few years. So like I was out for 3 weeks now, and generally most people seem to be quite positive on India. We had a lot of meetings and lots of asset allocators coming into the meetings.
Jyoti, so do you think in the near term, and as in the near term, in the short term, the brute force of money could really surprise us, and in the near term it's pointless to focus on market fundamentals because none of the fundamental arguments have made money. It is clearly liquidity and liquidity and momentum which is trumping everything else.
Yeah, sure. See, there are two things. One is, if you see historically, whenever interest rates are cut and there's a rate cutting cycle, whether it's in India, whether it's internationally, markets tend to go to valuations which are higher than what are long-term averages because the expectation always is that the future is going to be much better. So what you're playing is the cycle has bottomed out and you're expecting things to get much better in the future. So to that extent, even now, markets are like trading probably slightly above long-term averages and markets are starting to discount that things will get better. In a normal cycle, without the election and all, once rates keep getting cut, you expect that things will start improving 6-9 months down the road. This time, of course, we have the problem of elections, which may actually slow down the recovery a bit because near the election, people may get wary. You can't expect really investment cycle to pick off till you've had a new government in place. So that's why this time the delay may be more simply because of this whole election which comes in.
Ajay, one of the highlights of this week has been the fact that WPI has now slipped below 5%, and of course that's why we've seen banking stocks particularly run up. I have two questions for you. Firstly, are you just as hopeful as most people in the market seem to be about the fact that the RBI now will perhaps consider cutting rates a lot earlier than what most people were expecting? And number two, at this point, how would you be playing some of the banking counters?
I think if one were to read RBI's monetary policy issued on 3rd of May, I think the RBI has made it amply clear that they were expecting inflation to come off in the first half of FY14. They've said that for the full year, they're expecting it to be around 5.5% at the same time, and they're attributing it to the fact of to the past policy actions, falling commodity prices, as well as producers losing their power, and which manifests itself in the lower core inflation. At the same time, they've also said that they're expecting inflation to trend up in the second half of FY14. So, insofar as the surprise that the market is now, a section of the market is now expressing about WPI coming off quite sharply, I think the RBI had clearly hinted that they were expecting that. At the same time, what really changed the sentiment was that a lot of people were not penciling in the RBI to effect a rate cut in month of June, and they were expecting that the rate cuts, looking at the aggressive hawkish stance the RBI had enunciated, the rate cuts would happen sometime later. But now I think there is that the chorus is built into a crescendo that RBI will cut interest rates by 25 basis points in June, and the stance will be far more aggressive in terms of rate cuts as they go forward post-June. So whereas 50 basis points of total interest rate cuts were expected from now till the end of the year, I think people are now talking about 75 basis points of rate cut. And a second question on banks, I think clearly those public sector banks that have very high AFS book, as well as those banks which have a lot of wholesale funding, clearly will be the beneficiaries of this fall in interest rates. And to that extent, I think one has to look at a portfolio which is a prudent mix of good quality public sector banks which are over the hump insofar as NPAs are concerned. At the same time, also keep as part of core portfolio some of the private sector banks and NBFCs.
All right, gentlemen, we'll leave it at that. Many thanks for taking time out and speaking with us this